Good evening, everyone. This is Chris at 3 Point Capital. It's Sunday, March 3rd, 2019. And in these videos, we're going to showcase the 3 Point Capital data analytics and machine learning platform. And we're going to show you how you can use this application to locate high probability trade setups in the futures markets. Now, if you make it a habit to continually take bets that have a 60 or 70% probability of paying you off 2 to 1, 3 to 1, or 4 to 1, but betting in such a way that you know that the next outcome is random, so you're protecting your account equity, then what you'll find is over time you're going to have a very profitable trading system. So the first thing we want to point out here is the risk disclaimer, which you can see on our website at 3pointcap.com in the member area, risk disclaimers. As you all should know, trading futures and futures options is a risky business. You own that risk, and it's up to you to manage that risk. Now, luckily, we have options which can make that pretty easy to make sure you don't get blown up, and we will talk about that as well. Okay, so this evening we want to talk about two interesting setups we're seeing on the long side in both coffee and wheat. And first, we're going to start with coffee. The first thing I want to point out is the long-term chart here, which is actually a very, very ugly picture. Now we're going to pan out going back to 2011. So this is something we refer to at 3 Point Capital as gamma ray resistance. So just as the sun has the solar wind constantly firing, constantly sending dangerous particles towards the earth, it's very similar in an established downtrend where you'll have downtrend lines coming from various levels and sending massive waves of resistance. So here we can see we have resistance coming from 2011, then through 2014, next through 2016, 17, and then towards the end of last year in 2018. So we can see all these downtrend lines coming between the 120 level, right where we are here at the dollar price. So you can see clearly the pressure that coffee's been under for years. Now, that being said, we're starting to see a couple indicators that a bottom's trying to be put in. Now, the first thing I want to go back is point out here is this hammer candlestick on the weekly chart. Okay, so this was back in September of last year, middle of September. And you can see after that weekly hammer, we had a significant rally back through some of these resistant lines up to the 125 level before we rolled back over. So what's really happened since then, since that top, is we've pulled back and we've actually tested this low twice now. So in the middle of December, we came down to around the 98.5 level, holding just above these lows as we started to rally again. In January, we roll over again, and now again last week we put in a very similar looking candle, a nice hammer here on higher volume. So it's pretty evident that buyers are starting to step in here, and this type of setup is really piquing our interest, notwithstanding all of the overhead resistance that we have here. Now, two things that we want to point out technically. On this chart, we basically have our proprietary indicators overlaid over the chart. So we have an adaptive price channel on 3 different time frames. Now, the ones we have overlaid on the chart are the 23 weekly adaptive channel and the 4-week adaptive channel. Now, the interesting thing is, even though we've had all of this negative tape action since October, you can see that the 23 channel is actually sloping up, okay? And I'll tell you why we find that interesting. Now, when we go over within the Alchemist platform, we have something called a query table. And really what that allows you to do is look at any scenario or position and then observe how price performed 5, 10, 20, or 40 days and weeks going forward. Okay, so what we have here is the query table, and what this enables us to do is to look at prior instances that we've had similar technical setups as we have today. Okay, so what we have here is on the 23 weekly, we have a situation where the price location is below the 23 weekly low, so we're in a down location. However, the 23 moving average is actually trending higher, okay? So 23 location down, trend is up, right? And so now depending on your time horizon or your view, I mean, we're able to go back and look at all instances from 1972 where you see there's been 113 such instances. But we're kind of interested in everything from 2008 going forward. And the reason we look at 2008 is because since the GFC, things have dramatically changed with all of the central bank intervention and money printing and, pumping all this liquidity into the market. So, basically all risk assets have had a very different personality since that time. Now, what we want to point out here is, let's look at the results, okay? So since 2008, we've had 29 such instances on a weekly basis. And over the ensuing 5 weeks, what we see is in 70% of cases, 5 weeks forward, price is over 5 cents higher, okay, from the closing point. And it's only 3 cents lower. Okay, so we have a situation here where this is 5-3 bull to bear odds. Now, if we go out 10 weeks, so let's say 2.5 months forward, 70% of the time, price will advance almost 10 cents, and it only declines 3.4. Okay, so this is now 3-1 bull to bear odds. So these are the type of technical setups that we like to see. Okay, so again, let's go back to our price chart. We have a situation where we have 2 testing of weekly lows that were set in September. Okay, the low there is holding. And what's nice about it is we have a nice logical stop right at 95 cents. So we know if our theory and our thesis is correct, the 95-cent level should hold. And with prices sitting here right at $1, we're sitting with a pretty tight stop, which is nice. Now, given this technical setup where the 23 weekly adaptive moving channel is trending higher and prices below, we see that price distribution is very bullish in such instances. Okay. Now there's one other interesting piece to the puzzle, and looking back at the chart here, someone's buying here. There's definitely a bid going on that we can see, and we want to try to figure out who that is. So we're going to go over to our commitment of trader analytics. Okay, so we want to look at producer merchants and see what they've been up to. Now, the first thing we want to point out is that the net position of the producer merchants of long almost 6,000 contracts, that puts us at an 18-month score of 48. So pretty neutral, okay? Pretty neutral. But what has caught our eye is what's been happening here during this price decline. So first of all, about a few months ago, towards the end of October, when we were at the 112 level, we can see the producer merchants were short 15,000 contracts. And here, 21,000. And they're kind of sitting there between 16 and 20,000 short up until the end of November. Now, as price has dropped pretty significantly over the past 2 months, we can see them covering and actually getting net long. Now, what really jumped out at us actually is their short activity. Okay, so sorry, the one thing that we forgot to mention is that due to the government shutdown, we're still trying to get caught up. So the CFTC has only released data through February 19th. Okay, but at that point, coffee was basically testing the lows, sitting there at 97 cents. And what were producer merchants doing at that time? Well, during that week, where you had a 3 cent drop and actually a 7 cent drop over the prior 2 weeks, producer merchants covered almost 22,000 short contracts, right? So, again, what we're doing in our commitment of trader analytics is we're analyzing how this activity relates through the prior 18 months and 5 years, okay? And then we rank that activity to determine when we're seeing extremes in activity and participant positioning. So, covering 22,000 short contracts on an 18th month basis scores 100%. Okay. Now I want to go back to our query table. All right. So we're looking at coffee. We want to look at the disaggregated futures report, and we want to look at producer merchants. And what we want to say is, this is the one we want to look at. Producer merchant short weekly change 18-month score. Okay. So I want to see every instance where we've had a score greater than 98. Hit go. So we've only seen 13 instances going back to 2008. So you're pretty much seeing this type of sharp short covering about once a year, okay? And what we have here is 20 days forward, 70th percentile move is 540, while the down move is only 230, okay? So here's another situation where within a month we see over 2-to-1 odds in bulls' favor, okay? So producer merchants here heavily covering up the shorts, and historically that's been very bullish for price. Okay, so now that we know that we have high probabilities in our favor of at least some sort of rally into key resistance zones happening here. Sorry, let me go back to our chart. Okay, so at this point, really what we're looking for here is, we believe coffee is going to be testing the 23 adaptive channel low and up through the 23 adaptive channel high around the 111 area. So we think there will be definitely some resistance here. And then, of course, we're coming into that gamma ray resistance that we talked about around the 120 level. So again, we just want to highlight that, even when you have situations where, we have very high probabilities in our favor to bet long here, it's very easy to go broke if you're betting like something's going to happen, okay? So we want to place the odds in our favor, but we want to bet conservatively. Now, really what we like here is we're going to bring over the option screen. Okay, so looking at coffee, currently we're at $1, okay? And you can see calls and puts are priced very similarly here at this level, okay? Now, what we like here is the skew on the options. And what you can see is a put 5 cents out of the money is trading bid 144, asking 152. So roughly we're just going to call it 1.5 cents, okay? Now, a call that's 10 cents out of the money, well, that's trading for around 115. So very similar price between a call 10 cents out of the money and a put 5 cents out of the money. This is telling us that option traders don't see a very high likelihood of prices dropping below 95 cents. This is enabling us to sell calls out of the money to help finance some protection. So really what we recommend doing here is we're looking to go along these futures right here, right around $1. We're going to buy 95-cent puts as protection. Okay, so what this is referred to is a risk reversal, okay? And you can see here that our delta, or our expected hedge, is around 45. So, if for some reason prices were to drop to 95 cents or below, instead of losing 5 cents, your hedge should cover off between 2 and 2.5 cents of that loss, okay? Now, if that were to happen, our thesis would be proven wrong. We're going to want to close out of that trade and look to re-enter. Okay, so in conclusion here on the coffee, very compelling setup, both technically, the odds based off of technical position, as well as the extreme short covering we're seeing from producer merchant category. It looks to us like coffee is going to be rallying. Okay. Now, the next thing we want to talk about is wheat. Let me get this option screen out of the way. Now, a few days back on March 23rd, we put a note out to all of our clients regarding a terrific setup in wheat. Basically, the trade thesis here was the sharp decline below the 4-day adaptive moving channel. And really what we found there is that this was an extreme, okay? So if we have price is stretched 14 cents below the 4-day adaptive channel low, that's putting us with a very low score of 26 when we measure that, okay, over on an 18th month basis. So typically prices will not dip very far below the 4-channel low or very high above the 4-channel high, and that's just because of the way the adaptive channel is structured. Price tends to stay in the middle. So anytime you see prices diving below, it's going to have your 18th month score dropping below 50, and even here towards 26. So this was a situation where we were able to measure that, and really what we found was that the setup was quite compelling. Okay, seen that 26 times with a 70th percentile advance of 28 cents versus a decline of only 6. Okay, so very good odds, and we played that. We hedged with a put, and we were stopped out. We lost 9 cents, and the reason why it's important to do that is because the underlying thesis can be correct, but you don't necessarily know, if it's going to happen right away or not. So it's better to get stopped out, and then you have a chance to get back in at an even better price. And that's what we want to point out here on the wheat. And here we go. So again, clear downtrend. We can see prices diving below the 4-channel low, which was definitely piquing our interest. We're stopped out for a small loss, but now here we have another sign of a bottom. Very defined hammer candle on the weekly, on the daily price chart. We can see that price now dived below the 4-day adaptive channel low, and it closed really right at that level, and it was a good uptick in volume as well. We can see the oscillator is way into oversold territory. So again, we believe we're due for a bounce here. Now again, when we see this type of activity, we want to get an idea of what's going on and what commercial participants are doing. So let's go here, let's go to our commitment of traders report. I want to take a look at wheat. Okay. Now again, just reminding you guys, this is as of February 19th. And what we have here is, as prices was diving below $5, we can see on the week of the 19th that wheat dropped 30 cents, okay? And during that period, what do we see? We see commercial buying of almost 28,000 contracts, okay? So that scores a 91 on an 18th month basis, and their 4-week buying actually of 39,000 contracts scores at 91%. So we can see here massive buying by commercial traders. Now, if we go over to grains, we look at wheat. Just want to clear our filter. Okay, so we want to look at wheat. We want to look at the commitment of traders report. We want to look at commercial activity, and we want to see net commercial weekly change score of greater than or equal to 90, which is what we saw on February 19th. Okay, so what we can see is 20 days forward. Look at the average move, 40 cents up versus only 20 cents down. Okay, 2 to 1. Now, in the 70th percentile, it's 17 cents up versus only 7 down. So now you're looking at 2.5 to 1 bull bear odds in this type of situation. Now going back to our report on the 23rd, we still have this situation in effect where we gave that extreme close below the 4-channel low. So this was also calling for a higher price. So again, 2 pieces of evidence here with the wheat, saying that we're definitely due for a 20 to 30 cent rally. And we want to structure this trade in a similar way. We have price here sitting right around the 455 level. We'd be looking at 445 for a stop. So you can go long. Buy your 445 put as a hedge. We just wouldn't sell that call yet. We just so oversold and due for a rally. Basically what we'd be looking to do is waiting for a 10 or 15 cent rally. We know there's some chatter going on right now about a U.S.-China trade deal being done. People are expecting that to be bullish for soybeans, and I just think in general that's going to end up causing some short covering and a relief rally across the grains complex. So, we'd wait to sell that call. And just really quickly, if we look at the wheat options, Okay, so 53 days out, the 445 puts are trading for about 10 and a half. Okay, so we'd be looking to buy those. Those have a delta of 35, and if price goes, if price were to drop and close below this hammer candle on the daily chart, we would then look to close again and look to re-enter. Now, for those of you who are concerned about not wanting to catch a falling knife and the negative technical position, what we do sometimes is we'll wait for this 4 adaptive channel to flatten out a bit. Okay, so wait for some confirmation, 1 or 2 up days kind of coming up into here. You're then going to see this 4 channel flattening, and then what you can do is wait for some sort of testing of the 4 channel low, which may be 5 or 10 cents higher from here. But some traders do like to wait for that confirmation. So that's the end of this evening's video. Once again, we just like to highlight, make sure you're placing those odds in your favor, and make sure you're protecting your downside, right? You gotta treat each bet as an individual bet. It's just like being in any game of chance. Protect your downside and realize your edge over a large enough sample distribution. Thanks, and we'll see you next time.